The Treasury Department in banks plays a vital role in managing the financial activities of the institution. This department is responsible for overseeing the bank's funding, liquidity, and risk management. The primary function of the Treasury Department is to ensure that the bank has sufficient liquidity to meet its financial obligations and to manage the bank's financial risks. The Treasury Department's key responsibilities include managing the bank's investment portfolio, monitoring cash flows, and maintaining the bank's liquidity position. They also oversee the management of the bank's foreign exchange and interest rate risks. Additionally, the Treasury Department is responsible for managing the bank's funding requirements, including raising capital and managing the bank's debt obligations. One of the most important functions of the Treasury Department is to manage the bank's liquidity. This involves ensuring that the bank has sufficient cash and liquid assets to meet its financial obligations. The Treasury Department achieves this by managing the bank's cash flows, investing in liquid assets, and maintaining a diversified funding base. The Treasury Department also plays a crucial role in managing the bank's financial risks. This includes managing interest rate risk, foreign exchange risk, and credit risk. To manage these risks, the Treasury Department uses various financial instruments, such as derivatives and hedging strategies. In practical terms, the Treasury Department's functions can be seen in the way it manages the bank's daily cash flows. For example, the Treasury Department may invest excess cash in short-term investments, such as commercial paper or Treasury bills, to generate returns and maintain liquidity. The department may also use derivatives, such as interest rate swaps, to manage the bank's interest rate risk. Best practices for the Treasury Department include maintaining a robust risk management framework, diversifying the bank's funding base, and regularly reviewing and updating the bank's liquidity management strategies. The Treasury Department should also ensure that it is complying with all relevant regulatory requirements and industry standards. In conclusion, the Treasury Department in banks plays a critical role in managing the financial activities of the institution. Its key responsibilities include managing the bank's investment portfolio, monitoring cash flows, and maintaining the bank's liquidity position. By following best practices and using various financial instruments, the Treasury Department can effectively manage the bank's financial risks and ensure that the bank remains financially stable.